Welcome to the Real Estate Forum, a podcast from the Paul Milstein Center for Real Estate at Columbia Business School. I'm your host, Raphael Sidelsky. This is your place for key insights into the evolving real estate landscape, from candid conversations with real estate thought leaders, including the esteemed faculty of the MBA Real Estate program, to cutting-edge research from the Milstein Center's Research Lab. Let's dive in. My guest today is David O'Reilly, the Chief Executive Officer of Howard Hughes Holdings, a publicly traded company that owns and develops large-scale mixed-use environments over decades that are akin to small cities. The company has 7 master plan communities across 5 states, totaling 118,000 acres with more than 400,000 residents and developments spanning single-family homes, multifamily office, retail, and condominiums. Its projects include the Woodlands outside Houston, Summerlin in Las Vegas, and Ward Village in Honolulu. Howard Hughes is 47% owned by Bill Ackman's Pershing Square and is now evolving towards a holding company model inspired by Berkshire Hathaway, including the planned acquisition of specialty insurer Vantage Group. David joined Howard Hughes in 2016 as Chief Financial Officer and later served as President before becoming CEO. Previously, he was CIO and CFO at Parkway Properties, and earlier held roles at Banyan Street Capital, Eola Capital, and in investment banking at Lehman Brothers and Barclays. David holds a Bachelor of Science in Civil Engineering from Tufts and an MBA from Columbia Business School. David, welcome to the Real Estate Forum.
Thank you so much. I've enjoyed what you've built with this podcast. It's been a great forum for thoughtful conversation. And honestly, it's been focused on where the industry's going rather than where it's been. So I've really enjoyed all of the episodes we've put together.
Well, thank you so much. I'd love to dive into your origin story. How did you go from studying civil engineering to working on Wall Street at Lehman Brothers?
Yeah, it was, I think I was Forrest Gump, the feather in the wind that just blew where it took me. I started in civil engineering because I was really drawn to how complex systems were built, how all the pieces came together and created something that just works in the real world. Over time, I became more interested in how those systems were financed, how they were valued, how they were sometimes even mispriced. And that's what pulled me into real estate investment banking. I think in hindsight, the path makes a lot of sense. Engineering taught me how the systems work. Wall Street taught me how the cycles work. And that combination is really where I've spent most of my career, at the intersection of operations and finance.
Like you said, that in hindsight, that makes a lot of sense. Are there any other lessons from investment banking and real estate capital markets that you're applying in your role today?
Oh, every day. I think over my time in investment banking at Lehman, then for a short cup of coffee at Barclays, it really taught me that the capital markets can be incredibly irrational over short periods of time, but very rational over the long term. And you can see how quickly sentiment can shift, how liquidity can disappear, how leverage can amplify good and bad decisions. But the biggest lesson I learned throughout all my time in investment banking was really around capital allocation. The best companies aren't just good at operating their assets, they're disciplined capital allocators. And I think at the CEO level, that's really what this becomes. It's a capital allocation business that happens to operate through real assets. And that lens has shaped how I've approached every role since.
When we first met, you were the Chief Investment Officer and CFO at Parkway Properties and Office REIT. We successfully bought some distressed office after the GFC. How do you think about office today as an asset class?
Parkway was a formative period in my career because it was really a period where the markets forced you to separate what's cyclical from what's structural. You had to be brutally honest. We looked at deals together. You had to be brutally honest about asset quality, market quality, tenant quality, and balance sheet resilience. For office today, I do think one of the biggest misconceptions is that it's one asset class. It's not. There's a huge difference between commodity office and environments that attract people and companies. And the market is starting to reprice that distinction. And I think that's going to continue over the next months, quarters, years. Offices are going away, light retail coming out of the GFC, it's evolving. But the dispersion of outcomes for where office is going to go, I think, is a lot wider than what people expect.
What attracted you to the Howard Hughes platform after being at Parkway Properties? And how have you managed being at transitioning from being at a REIT to being at a C Corp?
Well, Howard Hughes was and is unlike anything else in the public market. It has an extraordinary land position and embedded optionality. But what really drew me was the master plan and community model. It's one of the few models where great decisions actually compound over time. And when I actually interviewed for the role, one of the things Bill Ackman told me was, look, we're going to spend $1 billion a year developing these communities. We're never going to have to raise the dollar capital. And it's just about where we allocate those capitals to drive the highest risk-adjusted returns across our communities. And that was incredibly attractive. And, the C Corp model of not having to dividend out all of my free cash flow and using it to compound value over decades is incredibly attractive. Howard Hughes, we're not building assets. We're shaping the future of the place. And it's very different and much more strategic way to think about business.
Well, Howard Hughes itself has a fascinating history. You had these large land parcels originally assembled by the Howard Hughes that ended up inside of the mall owner General Growth Properties, which filed for bankruptcy during the Great Financial Crisis. Bill Ackman's Pershing Square invested heavily in GGP ahead of and through the restructuring. And when the company emerged from bankruptcy in 2010, it spun off the master plan community assets into a separately traded C Corp that became the Howard Hughes Corporation. Walk us through the unique self-funded virtuous cycle of the master plan community model.
Sure. I spend hours and weeks, months talking to investors about this, but we'll try and do it in 15 seconds. I think the easiest way to think about the MPC model is it's a flywheel, right? Most developers make a discrete bet on a postage stamp, on an individual asset. We're building the entire ecosystem. You start with the land, but the objective isn't to sell it as quickly as possible. It's to create a place that becomes steadily more valuable over time. Residential growth attracts retail. Retail then improves the quality of life. Improved quality of life attracts employers. Employers bring jobs, which drives more housing demand, which in turn makes the remaining of land much more valuable. And in each phase of that flywheel, if we do it well, it increases the value of the remaining land. What's often, I think, underappreciated is that the value isn't just created by what you build. It's created by when and what order you build it. And it's created not just in the buildings, but in the spaces between the buildings. I think that's a major differentiator of the MPC model. I mean, I would also say that over time, we think about decades in the MPC world, we really create optionality because we have the ability with this incredible land bank to respond to opportunities that don't exist yet. I'm responding to opportunities today that didn't exist 5 years ago. And whether they're different asset classes or different types of products or different needs of our community, it's all very different relative to what we expected going in.
Well, one of the interesting dynamics that you touched upon is this question of sort of balancing current development profits with long-term appreciation of the remaining land. In your communities like Summerlin, Bridgeland, and the Woodland Hills, your land values have grown 5 to 7% annually since 2017. So how do you balance this need for short-term profits and recycling capital with knowing that there is this long-term appreciation of the land itself?
That is the core central discipline of our business. If you optimize too heavily for short-term profit, you undermine long-term value. If you're too patient, you're leaving meaningful profits on the table. So the question we're always asking every day is what action today maximizes the long-term value of the entire ecosystem? And that's really where this becomes a capital allocation exercise. Deciding where to monetize, where to reinvest, and where to wait. And we're doing that inside of a public company model, which creates another layer of discipline in reporting. But at the end of the day, we're building to meet demand. When homes sell and builders need more land to build homes, we sell the land. When office buildings are full and we have demand for more tenants, we build. Same in multifamily. It's just building just in time to meet the demand in the market. And doing it through a different lens. I can tell you that most of my career in real estate, you can't be patient. You have to be first, right? You have to be the first to develop because there's 3 other guys coming behind you. And second, third, and fourth is going to lose. So you got to be first. Here at Howard Hughes, because we're the only developer within our communities, we don't have competition. There is no 2, 3, and 4. Patience is not a passive strategy. It's an active strategy for us. In waiting the right amount of time to build that product to maximize profitability.
So you have 34,000 acres or so of remaining developable land. Give us a flavor of how you think the mix of uses will be on those remaining sites.
The short answer is I'm wrong. Whatever the master plan is today, it's going to change in 6 months. Every 6 months, we're updating all of our plans. But we really start with a holistic view, demographics, affordability, job growth, consumer preferences. But part of the real art of what we're doing is sequence, right? The wrong product at the wrong time destroys value. The right product at the right time unlocks the next phase. And I like to think about it as if we're dropping pebbles in a pond where you create concentric circles. The right pebble, the right time, the right sequence, those concentric circles are value creation circles that increase the value of our land. The wrong product at the wrong time, the wrong place, it's a destructive circle. So that's really why I think about these communities as systems where every decision impacts everything else around it. And this business is as much about choreography as it is about construction.
Let's discuss some of your signature communities, starting with the Woodlands, which is over 50 years old. What has made the Woodlands this award-winning master plan community and such a powerful example of long-term value creation?
Oh, well, wow. So the Woodlands is 52 years old, started by George Mitchell, who's an oil man. And it's a great example of what happens when development's approached holistically over time. It was never just about housing. It was about creating a complete environment. And even when George Mitchell started the Woodlands and everyone said he was crazy in 1974, he wanted 1.5 miles for rooftop. And we're more than that today. Over time, it became more than a community. It became an economic system where that same flywheel that I talked about earlier exists. Residents came and that attracted retail. Retail made quality of life that attracted employers. Employers brought jobs, which means we needed more housing. And that is a perfect example of how the best communities don't just grow, but they're self-reinforced.
So that is a great example of moving from primarily residential development into this major employment and commercial center. Why don't we jump over to Las Vegas? Tell us about Summerlin, your success and the keys to the success there, and some of the latest developments.
Yeah, Summerlin is very similar to the Woodlands. It's just 20 years younger, right? And it's benefiting from that same consistency and same discipline over a long period of time. And it's grown, but it's intentional growth. We have 125,000 residents here in Summerlin. Those residents need great retail. 10 years ago, 11 years ago now, we built a 1 million square foot outdoor walkable retail shopping center. Since then, we've added 5 office buildings. They're all full. They brought jobs. We're selling more land. And that flywheel, again, it's that same recipe. And you can see it compound in the land value. Because when I started here at Howard Hughes 10 years ago, we were selling land to home builders in Summerlin at about $450,000 an acre. Today, we're selling those same acres to home builders at $1.8 million. And then we're in that sweet spot of the flywheel where residents, retail, jobs, residents. Yeah, and it just keeps going. It creates more and more demand.
Ward Village in Honolulu is a very different type of project, a large-scale urban redevelopment built around residential towers. The project has generated close to $8 billion in condo sales. How do you successfully manage development at such a large scale? And tell us a little bit about the vision for the retail remaining at the base.
Yeah, sure. So Ward Village is that same system, just where Woodlands and Summerlin are horizontal. Ward Village is vertical, and it is our master plan community. It's just a different expression of that same philosophy applied in more of an urban mixed use district. And the same principles apply. Execution matters above everything, right? Design, phasing, customer experience. With each tower we build, we're shifting product mix to meet changing consumer demand, adding to the vibrancy of the neighborhood, amenitizing the entire district with parks and great retail. And again, if we do it right, value compounds. As each successive tower is sold, hopefully at higher prices per foot and sold quicker and more efficiently. The goal with Ward Village is the same as with all of our master plans. It's not just building buildings, it's building a neighborhood.
And then you get left with this recurring income stream with, by example, the retail in the base.
Yeah, no, million square feet retail that we started with that, I was lucky to get $15 or $20 net rents at the time because they were World War II warehouses that were still staying up somehow. We knock them down. We put a brand new high-rise condominium tower on top of them with ground floor retail and mark those rents to market to $60, $70, or $80, I think. So in that retail, it's really about neighborhood amenities. What do our residents want? What makes it a better place to live? What makes it easier to get to a coffee shop, a restaurant, a place where I work out? Where do I walk my dog? It's amenitizing the neighborhood that creates that flywheel.
And you've also taken that condo model and imported it back to some of your other communities lately. Do you see yourself doing more in the way of condos outside of Honolulu?
Absolutely. I think that we've built an incredible machine of development there in terms of not just the sales strategy and sales machine and execution, but the design and construction discipline. And we've been able to bring that to the Woodlands with the first standalone Ritz-Carlton residences in the Woodlands. And we launched sales 2 years ago, a year and a half ago. We sold 60% of the building in 2 weeks. At which point, our chairman, Mr. Ackman, said, "Don't you sell another building until the building's finished. We're leaving money on the table." And he somehow squeaked a couple past the goalie, and I think we're up to 70%. But again, it's using, when you have a competitive advantage, you have a great team that can execute as well as anybody I think that I've ever seen. Our goal is to use that competitive advantage to the best of our abilities. And whether that's Honolulu, Woodlands, or here in Summerlin, where we'll probably have our next high-rise condominium tower, now we're going to continue to use that expertise that we have and apply it to all of our rooms.
You recently announced the Toro District, an 83-acre sports and entertainment destination anchored by the Houston Texans' new headquarters. Tell us about that and what it represents for the future of Bridgeland.
I talked earlier about how owning land for decades creates optionalities. And each acre is an option. And we really have a portfolio of options of what to do with this land, 34,000 options. And 5 years ago, if someone said, "Hey, a NFL headquarters training facility and practice field is a great catalyst for a mixed-use entertainment district," I don't know that I would have believed them. But today, that's a reality. And that's part of the option guide of this land is we have the option to execute on these things that create a sense of place, that bring dining, that bring medical office, that bring community services and gathering places to our communities, that give them a sense of vibrancy. Whereas I think the Woodlands, their catalysts and shift from residential involved the Woodlands Mall, an indoor mall, and then it involved the 500,000 square foot office building for Anadarko. Well, I'm glad we're not building an indoor mall in Bridgeland. I just didn't expect it to be a 6,000 seat stadium for a practice field for an NFL facility as a major catalyst to drive this redevelopment. I think it's going to really change the trajectory of Bridgeland and provide an incredible catalyst for future home sales for the next decade that we're selling land in. And I really think that's the advantage of how we think. We're thinking in decades, not in years.
Well, speaking of selling homes, have you ever considered developing homes yourself rather than selling to home builders?
Yeah, and for maybe half a minute, look, we evaluate everything through, capital allocation lens. And a big part of our success is knowing where we have structural advantages and where partnering creates better outcomes. The public home builders are large and they're incredible, and they do a much better job at building homes than we. That's not one of our competitive advantages. One of our competitive advantages is owning land, putting in the infrastructure, and selling it to those home builders. When we do that, we're selling that land at 80% cash margin from now until the selling. To bring in a really good home building business that is kind of a 15 to 20% margin and capital intensive business, we don't think would be additive. We're not trying to do everything. We're just trying to do the right things.
You've built at least one build for rent project. How did that go, and why haven't you done more of it given the popularity of that model right now and the housing affordability issues in the US?
Again, we're building to meet demand. And when we saw demand in Bridgeland, we brought that build rent community there. There are demand for homes for rent in all of our communities, but right now there's enough supply to meet it. This is why we haven't built those built for purpose for rent communities. There's a shadow market of rental homes in Ward Village, the shadow market of rental homes in Summerlin, in Bridgeland, in the Woodlands, that we don't see incremental demand that would drive outsized returns.
Got it. Pershing Square remains Howard Hughes' largest shareholder with a 47% stake, and Bill Ackman is your executive chairman. He's spoken about building Howard Hughes into the next Berkshire Hathaway, using the real estate platform together with insurance capital to compound value over time. What do you think about the plan, and how is it evolving?
Look, I think the holding company evolution, if you will, is really an extension, not a pivot for Howard Hughes. We already have a platform that compounds over. Our land bank clearly compounds over time. We talked about the value of land in Summerlin. That's the best example. And at its core, it's about deploying capital into opportunities that generate long-term returns. And we're not trying to replicate Berkshire. We're just applying that mindset to a platform that already has real assets and real cash flow at its face. I think it's a natural evolution of the same discipline. And it's an opportune time because our business now is hitting a point between the growth of our recurring NOI, office, multifamily, retail, the profitability of our land sales and condos. We have more cash than we can responsibly invest into our communities. And being able to upstream that capital from real estate into other potential widget manufacturers or other strong free cash flow businesses is an incredible opportunity.
Well, as Ackman said, Howard Hughes is starting from a much stronger foundation than Berkshire did in 1965, which just had a struggling textile mill. Part of the rationale behind the acquisition of Vantage Group is to take advantage of the significant investment float, which was a powerful engine and remains a powerful engine for Berkshire. So tell us a little bit more about how both your real estate profits and insurance float are going to interplay with Pershing Square and their investments.
One of the unique aspects of our real estate platform, particularly with our master communities, it's inherently long duration. We're creating value over decades. Insurance capital, when managed well, also has a long duration profile. So the combination can be powerful. We're pairing long-term capital with long-term assets. But what really ties all of this together is capital allocation. We now have a broader pool of capital that can be deployed into opportunities where we see long-term value. Within our real estate business, we're allocating capital between office, multifamily, land, condos, et cetera. Within the insurance business Advantage, you'll be allocating capital between reinsurance, D&O, the property and casualty, et cetera. And then at the holding company level, we'll be able to work arm in arm with Pershing and Bill and Ryan to figure out where we're allocating capital between real estate, insurance, or the next business that we could buy. So I think that insurance has a great role. I think that I may have gone into the wrong business at the end of the day. If you're in real estate, we spend oodles of money, technicals are oodles, in the hopes that someday someone pays us rent back over time. And in insurance, they pay you first. under the promise that you might pay them back someday. But we have it backwards in real estate. This insurance thing is fantastic. And when you can imply that investment of float into Pershing's track record of delivering 20% plus returns over 20 plus years, that's a really powerful engine.
How is the current environment in real estate, higher interest rates, tighter capital markets, reshaping decisions across the industry? And how are you in a differentiated position from others at the moment?
I would love to tell you that Howard Hughes is very different and there were no capital constraints, but that's clearly not the case. Right now, the higher interest rates and tighter lending standards and more challenging capital markets is forcing discipline. And that is really helpful for our industry. When capital is in abundance and flown like rivers, it hides mistakes. When capital is constrained, business models get tested. And in that environment, long duration landowners with flexible balance sheets and lower leverage, I believe, have an advantage. Look, when capital is scarce, optionality is more valuable than it ever is. And I think that really plays into how we team.
Well, another great thing about your model is that, unlike the example you gave of, a great corner site somewhere in Texas where 4 developers are each developing on the different corners, you can actually control your supply. And would you say you've done that in a way leading into the cycle where you've controlled your supply in a way that's different than other submarkets?
Yeah, I'm telling you that right now we have the least amount of development in the ground in process in the company in 5 years. And it is, again, it goes back to patience as a business plan, because rents have not kept up with inflationary construction costs, operating costs, real estate taxes, utilities in a way that makes those deals rough. There are still times where we can find great development opportunities. We just built a new multifamily project in the Woodlands that is doing incredibly well. But the 8 buildings we have in the Woodlands were 99% leased and rents were up 11% on a same store basis. Okay, that makes sense. But that's not the case everywhere. So I think that discipline, patience will accrue to better returns when we do put shovels back in the ground. And again, we're never building 2 multifamily at a time, 2 office at a time. To your point, controlling supply and creating demand gives us, I believe, a competitive advantage in de-risking the development mix.
What are the leadership lessons you've learned managing projects and an organization that operates on this multi-decade time horizon?
Oh, man. I think with businesses with long feedback loops, judgment matters more. I've been fortunate to learn from great mentors. And over time, you realize the frameworks for making decisions are often as important as the decisions you make. You'll make better decisions when you build great frameworks. But to directly answer your question, what have I learned? I learned that over the wall, often, maybe even always, right? The master plans that we've laid out 6 months ago are wrong, right? The consumer demand changes, business demand changes, they're constantly evolving. And our plans need to evolve as quickly as that underlying demand. So I would say that the biggest lesson in all that is that you have to really have a great balance of conviction and adaptability as you execute.
And what has drawn you to and kept you in the real estate public markets for so long?
I think that the opportunity Parkway was a tremendous one where we could turn around what was an over-levered and broken public REIT. We sold every asset that it owned except for 2. We reinvested into some great Sunbelt submarkets. 5 years later, we took an $8 a share REIT and it sold it in a complicated transaction to Cousins for $20. It just so happened to be a public wrap. Howard Hughes is a generational wealth building machine that compounds like no other real estate investment or company I've ever seen. And it just so happens to be in a public wrap. I don't know that I've sought jobs in the public realm as much as I've sought jobs that happen to be with companies that traded.
How did your time at Columbia and your involvement with the school impact your career and perspective on real estate?
Look, I'll tie back to how we started and say that it was really in Columbia where it honed my focus on what I wanted to do for the rest of my life, right? Professional, career-wise, not personal. Because it really shaped the fact that real estate sits at the intersection of finance, operations, and placement. And when those three areas come together, that area that overlaps with them, that's what I fell in love with. And those are the opportunities and jobs that I've pursued and chased. And it's why I love the opportunity at Howard Hughes so much, because every single day we're figuring out how to operate our assets better, we're figuring out how to finance them better, and we're figuring out how to make better places, better communities for all of our residents.
What do you see as the biggest opportunities and challenges for large-scale community development in the U.S. over the next decade?
Oh man, well, the opportunity is enormous. There's no doubt about that. We need more housing. We need better communities. Depending on which research you read, whether it's John Burns, Cialco, whom have you, we're probably short 3 to 5 million homes across the communities, across our country. So, and part of what we're able to do is meet that demand. So the opportunity is that we have an incredible amount of demands, and we have the raw acreage to meet that demand. The challenge is really in affordability, and it's delivering supply at a price that people can afford. And that's hard. And one of the keys and one of the ways that we're able to, I think, specifically address it, while our home sales in our master plan communities have meaningfully exceeded kind of the national narrative, is that we made smart, thoughtful, timed investments in infrastructure. And in Texas, we're reimbursed on that infrastructure through municipal districts. In Vegas, we're reimbursed here through the special improvement districts, Phoenix in the community financing districts, all of which creates an affordable landscape for homes, because we can develop land at a higher profit margin at a lower cost and deliver that land to home builders at a basis that allows for someone who's moving from California, for example, to buy twice the home for half the price you're selling. And that's really the challenge, is continuing to tweak the product mix, the size of the homes, the cost of the infrastructure, so that we can deliver efficiently and allow that affordability to come back into line and accelerate consumers' access to homes. And that's at the end of the day, where really execution comes into play.
David, I always like to ask a non-real estate related closing question. Is there a book, a habit, a philosophy, a mode of exercise, a life lesson, or something else that you would like to share that's been meaningful to you?
I was hearing the advice that my mother gave to me every day growing up. It's meaningful to me because, as I've mentioned throughout this time, is that compounding is really important, right? In finance. Compounding in finance is like one of the big key things. But it's also important in life. And my mother used to drive me to hockey practice, and we lost my mother over a decade ago to ovarian cancer, but I didn't think about her every day. And she would drive me to hockey practice, and she would say, look, you're not the fastest. You don't have the best shot. You're not the best stick handler, and you're certainly not going to be the best player on the ice. But you can decide before you get out of this car if you're going to work the hardest. Is that something you decide and no one can ever take away from you? So I would tell you that my life lesson and something that I focus on every day is working harder than everybody else every day. And if I work just 1% harder every day, and that compounds over time, think about how much further ahead you could be at the end of a week, a month, a year, a decade.
Absolutely. Thanks for sharing that with us. And thank you so much for joining us on the Real Estate Forum podcast. We look forward to seeing how you continue to build out these communities into vibrant live, work, play environments and scale the holding company into the next Berkshire Hathaway.
Appreciate your time. It was a pleasure, sir.
Thank you for listening to the Real Estate Forum, a podcast brought to you by the Paul Milstein Center for Real Estate at Columbia Business School. Be sure to subscribe for more insights from real estate thought leaders, industry professionals, faculty, and the latest research and expertise from the Milstein Center's Research Lab at Columbia Business School. If you've enjoyed the episode, please follow, rate, and share the podcast. You can keep up to date with the Paul Milstein Center for Real Estate at business.columbia.edu/real estate. Thanks again for joining us, and we will see you next time.